Now, let us work through the next section, classification. To determine the classification of a financial asset, the business model must be determined. This is the reason for the entity having this data or financial asset in the first place. The objective must be determined. Does the entity hold the asset to collect the contractual cash flow over the life of the instrument, or does it hold to sell to realize cash flows, mainly through the sale of the financial asset? For example, buying and selling shares for short-term profit-making, or perhaps a combination of the two. For example, hold to collect, and when the opportunity comes around, sell it. In this case, the objective is to collect contractual cash flows and sell financial assets. The frequency and the value of sales in financial assets are usually greater than those held to collect. When we talk about holding to collect contractual cash flows, the revised standards incorporate the SPPI test, or the solely payment of principal and interest test. An entity should determine if the contractual cash flows of a financial asset are solely payment of principal and interest, where principal is the fair value of the financial asset at initial recognition. Interest is the consideration of the time value of money and the credit risk, but may include other basic lending risks and costs and a profit margin. The test considers the cash flow of a financial asset. It considers the specified date, even on demand, is a specified date. This means if there is no specified date, the financial asset will be held at fair value. For the SPPI test, it considers the maximum requirements in terms of the amount and interest. Interest on the principal amount with time value for money, credit risk, liquidity risk, profit margin, and costs. Contractual cash flows meet the SPPI test when the principal amounts outstanding are consistent with a basic lending arrangement. In a basic lending arrangement, consideration for the time value of money and credit risk are typically the most significant elements of interest. The classification of financial assets can be summarized as follows. The classification can be at amortized cost, fair value through surplus or deficit, or at cost. It depends on the business model and the contractual cash flows, or the SPPI test as discussed. If the business model is to hold the financial asset to collect contractual cash flows over the life of the instrument, and the SPPI test is passed, then the financial asset is classified at amortized cost. If the business model is to hold to sell, then the default classification of the financial asset is at fair value through surplus or deficit. If the financial asset is an investment, residual interest, and the fair value cannot be measured reliably, then the financial asset is classified at cost. Let us consider some examples. Entity H provided a loan to its subsidiary Entity S. The loan is classified as part of the current assets in the records of Entity H. The loan has the following terms: interest-free, no repayment terms, repayable on demand. How would the loan be classified? The business model is hold to collect the contractual cash flows over the life of the instrument. As previously indicated, even on demand is a specified date. The financial asset is thus classified at amortized cost. The second example is up next. Entity L provides a loan to Entity B to the value of 2 million rand with fixed repayment terms at a rate of 10%. If Entity B misses 2 consecutive payments, then the interest rate will increase to 12%. How would the loan be classified? The business model is hold to collect contractual cash flows over the life of the instrument. The financial asset is thus classified at amortized cost. Let us consider example 3. Entity ABC provides a loan to Entity XYZ. The terms of the loan are as follows: 10 million rand with fixed quarterly repayments and interest at 8%. Interest is repayable in US dollars. The interest is calculated at 8% of the loan, then converted to US dollars and paid over to Entity B. How would the loan be classified? The business model is to hold to collect contractual cash flows over the life of the instrument. However, the SPPI test is not passed as the interest rate is linked to risk and changes in the US dollar. The financial asset is then classified into default category, which is fair value through surplus or deficit. Now that we have considered the classification of financial asset, let us discuss the classification of financial liabilities. The classification of financial liabilities can be summarized as follows. The default is that all financial liabilities are classified at amortized cost, fair value through surplus or deficit, and for other categories, namely loan commitments, held for trading, financial guarantee contracts, and transfers that do not qualify for recognition. We will consider these 4 categories in the next slide. An entity may irrevocably designate a financial liability as measured at fair value through surplus or deficit if doing so results in more relevant information because either it eliminates or significantly reduces a measurement or recognition inconsistency, for example, accounting mismatch, or a group of financial liabilities or financial assets and financial liabilities are managed and their performance is evaluated on a fair value basis based on a documented risk management or investment strategy. The 4 other categories include financial liabilities that arise when a transfer of financial asset does not qualify for derecognition are measured in accordance with the transfer requirements. Financial guarantee contracts, in this case, surety is signed on behalf of another party, are measured at the higher of initial recognition, less amortization or impairment. Commitments to provide a loan at a below market interest rate are measured at the higher of initial recognition, less amortization or impairment. Contingent consideration recognized by an acquirer in a transfer of functions between entities not under control, measured at fair value. Now that we have concluded our discussion on the classification of financial assets and financial liabilities, let us continue our session with the next topic of reclassification. When can financial assets be reclassified? Financial assets are reclassified when there is a change in management model or reliable measure of fair value becomes or ceases to be available for investment in residual interests. Regardless of the management model and cash flow characteristic assessment, financial assets may, at initial recognition, be irrevocably classified at fair value through surplus or deficit, if doing so eliminates or significantly reduces an accounting mismatch. When can financial liabilities be reclassified? Financial liabilities cannot be reclassified. The exception is irrevocable.